What if I told you the financial markets today might be mirroring the dangerous optimism right before the Great Depression? In this video, we're diving deep into the eerie similarities and surprising differences between the roaring 1920s and our post-COVID boom. From irrational market exuberance to tariff wars and technological revolutions, let's break down whether history is repeating itself or if we're entering uncharted territory. Hit that like button, subscribe, and let's get into it. Let's start with the backdrop. The late 1800s and early 1900s, known as the Gilded Age, were defined by massive industrial growth, tech innovation like the telephone and electricity, and a widening wealth gap. Sound familiar? Fast forward to post-COVID America. We've seen a record surge in tech innovation, AI, crypto, remote work platforms, and an explosion in asset prices, from housing to stocks to NFTs. Just like back then, a small elite captured most of the gains, while the average household fell behind. The top 10% today own over 70% of stock market wealth, echoing the income inequality of the 1920s. Both periods were driven by new technologies, rapid urbanization, and a belief that the good times would never end. In the 1920s, Americans piled into the stock market like never before. People borrowed money on margin to buy stocks, believing prices would rise forever. Sound familiar? Post-2020, we saw meme stock mania, crypto euphoria, zero-commission trading, and SPAC explosions. Platforms like Robinhood made it easier than ever for retail investors to speculate. Back then, it was radios and auto companies. Today, it's AI, semiconductors, and the next big thing. But here's the kicker. In both cases, fundamentals didn't matter. It was all about hype. Economist Irving Fisher famously said in 1929 that stocks had reached a permanently high plateau. Weeks later, the market crashed. Today, many argue this time is different, but history warns us. When optimism replaces logic, bubbles pop. Next up, trade policy. In 1930, Congress passed the Smoot-Hawley Tariff Act, raising tariffs on over 20,000 goods. It triggered a global trade war and worsened the Great Depression. Fast forward to 2018 to 2020. Under President Trump, the U.S. launched tariffs on Chinese imports, sparking retaliatory measures. While not as extreme as Smoot-Hawley, the Trump tariffs disrupted global supply chains and added to inflationary pressures during the COVID rebound. Both periods reflect a turn inward, a rise in economic nationalism, and a belief that protecting domestic industry would strengthen the economy. But economists largely agree. Tariff wars hurt consumers, reduce trade, and introduce uncertainty. Another red flag, loose monetary policy and excessive credit. In the 1920s, the Federal Reserve kept rates low to stimulate growth. Easy credit fueled speculation and over-leveraged consumers. Sound familiar again? Post-2020, the Fed slashed interest rates to near zero and printed trillions of dollars in stimulus. This led to massive market liquidity and the everything rally. Stocks, crypto, housing, collectibles. But now, just like in 1929, we're seeing the reverse. Aggressive interest rate hikes to fight inflation. And historically, these cycles end badly. Debt-fueled booms often lead to painful deleveraging. Despite the similarities, there are some major differences. Banking safeguards. After the Depression, we created the FDIC, the SEC, and stricter financial regulations. Global coordination. Central banks today communicate and act in sync. And social safety nets, unemployment insurance, food programs, and stimulus checks didn't exist in the 1930s. Plus, today's economy is far more diverse, with tech, services, and global trade balancing out industrial swings. While we still see bubbles and inequality, we now have tools to respond faster if we use them wisely. So are we headed for another Great Depression? Maybe not, but the warning signs are there. Excessive risk-taking, inequality, overvalued markets, and rising protectionism. History doesn't repeat itself exactly, but it often rhymes. The question is, will we listen? Drop a comment below. Do you think we're heading for a crash? Or is the economy strong enough to weather the storm? Smash that like button, subscribe to the channel, and share this with someone who needs a reality check on the markets. Stay smart, stay curious, and keep building your financial freedom.